part of the presentation for Chapter 23, Statement of Cash Flows. In this learning objective, we will contrast the direct and indirect methods of calculating net cash flow from operating activities. This slide illustrates the major sources and uses of cash for companies. This information is part of the computation of net cash flows from operating activities using the direct method. The direct method computes net cash provided by operating activities by adjusting information in the income statement from accrual basis accounting to cash basis. We will illustrate the direct method in the next slides. The cash receipts from customers is determined by taking the sales revenue reported on the income statement and adding decreases in accounts receivable or subtracting increases in accounts receivable. This is similar to the indirect method where decreases in accounts receivable were added to net income and increases were subtracted. To determine the payments to suppliers, we use cost of goods sold from the income statement and adjust it for both changes in inventory and accounts payable. To determine cash payments for operating expenses, we take operating expenses as reported on the income statement and adjust for changes in prepaid expenses and accrued expenses payable. Since cost of goods sold and operating expenses are adjusted directly from the income statement, the additions and subtractions are opposite of those made when using the indirect method because cost of goods sold and operating expenses are both subtracted to arrive at net income. This slide shows a simple operating activities section for Emig Company using the direct method. The cash received from customers is the first amount shown, and from this the cash payments to suppliers for operating expenses and income taxes is subtracted to arrive at net cash provided by operating activities. The FASB encourages companies to provide further breakdowns and payments that they consider meaningful when using the direct method. But as a minimum, companies need to show separately the cash collected from customers, interest and dividends received, and other operating cash payments, if any, in the presentation of operating activities using the direct method. In the cash payments section, the companies are required as a minimum to report separately the cash paid to employees and suppliers of goods and services, interest paid, income taxes paid, and other operating cash payments, if any. Companies using the indirect method must disclose separately changes in inventory, receivables, and payables in order to reconcile net income to net cash flows from operating activities. In addition, they must disclose elsewhere in the financial statements or in the notes interest paid, net of amount capitalized, and income taxes paid. The FASB requires these separate and additional disclosures so that users may approximate the direct method. In this learning objective, we will be covering some of the special problems encountered in preparing a statement of cash flows. As we discussed in the first presentation, companies must make many non-cash adjustments to arrive at net income. These non-cash adjustments have to be added and subtracted to net income when the indirect method is used in order to arrive at net cash flows provided by operating activities. Two of the non-cash deductions are depreciation and amortization of intangibles and bond discounts or premiums. Depreciation and amortization of intangibles and bond discounts need to be added back to net income, and amortization of bond premiums would need to be subtracted. Also, companies should adjust net income for the difference between the cash paid for post-retirement benefits and the expenses reported on the balance sheet. Changes in deferred income taxes affect net income but have no effect on cash. If you remember from Chapter 19, the net change in deferred assets and liabilities is netted with the current income taxes payable to determine the provision for taxes. This net change is non-cash and should be either subtracted or added to net income in the operating activities section. Also, companies that use the equity method of accounting record investment income or loss for their percentage ownership in the investee's net income or losses. These amounts are non-cash. Also, dividends received are credited against the investment account. Therefore, the net increase or decrease in the investment account does not affect cash flows. A company must deduct the net increase or decrease from net income to arrive at net cash flows from operating activities. Gains and losses on the sale of assets are included in the computation of net income. However, losses should be added back to net income to determine net cash flows from operating activities because they are non-cash. Gains do represent cash, but since the proceeds from the sale of long-term assets and investments are included in the investing activities section, they should be subtracted from net income in the operating activities section to prevent their double counting. Unrealized gains and losses that are included in net income as part of the adjustment of securities to their fair value at the end of the period would also have to be included in the adjustments to net income in order to calculate the cash provided by operating activities, since they do not represent cash paid or received. If you remember from Chapter 16, we discussed the reporting of compensation expense for stock options. The compensation expense is calculated based on the fair value of the options on the grant date, but do not represent cash expenses. Therefore, the company should increase net income by the amount of compensation expense from stock options in computing net cash flow from operations. Later, if the employees exercise the stock options, then the cash received on exercise would be reported in the financing section of the cash flow statement. When companies report unusual and infrequent items in net income, these should be removed from net income and reported in the statement where they belong. An example would be if the company reported a gain on condemnation of land. This gain would be included in the computation of net income, but it would need to be subtracted in the cash flow statement and the entire proceeds reported in the investing section of the statement of cash flows. Accounts receivable and the allowance for bad debts can be netted when the indirect method of reporting the operating activities is used. In the example shown, the increase in accounts receivable of $15,000 could be subtracted from net income separately, and the increase of $6,000 in the allowance for doubtful accounts could also be added separately to net income. Alternatively, the net increase of $9,000 could be shown because both sales and bad debt expense are included in the computation of net income. This slide shows the separate presentation of the two accounts, but with the net amount of $9,000 subtracted from net income of $46,000 to arrive at the net cash provided of $31,000. Alternatively, the net amount can be shown by itself as a subtraction from net income, as shown in this slide. However, when we use the direct method of presenting the operating activities, the bad debt expense of $6,000 shown in the income statement above would not be included in the computation of net cash flows from operating activities because it is a non-cash amount. Therefore, if we are using the direct method of presentation for the operating activities section, we should not net the change in accounts receivable and allowance for bad debts. If we did, we would be subtracting the $6,000 of bad debts that is not included. The correct presentation of cash received from customers would be $100,000 of sales minus the whole $15,000 increase in accounts receivable and not the netted amount. It is important to remember that not all changes in working capital go through net income. Therefore, when we are analyzing the current asset and liability accounts, we need to make sure that we don't exclude these. Some examples of these are purchases of short-term available for sale securities, issuance of short-term non-trade notes payable for cash, and the payment of cash dividends. Short-term trading securities are classified as operating activities. However, short-term available for sale securities are included in the investing activities section, and purchases of short-term non-trade notes payable and payments of dividends are included in the financing activities section. An additional consideration for dividends is that only the dividends actually paid are included in the financing activities of the statement of cash flows and not those that are declared but unpaid. Another issue is, what do you do when the company has a net loss rather than net income for the period? There is no difference in the reporting. Both non-cash items as well as the changes in the current assets and liabilities are added and subtracted from the net loss as already discussed. As shown in this example, both the depreciation and the amortization of the patents are added back to the net loss to determine net cash provided by operating activities. As we can see by this slide, it is possible to have positive cash provided by operating activities even if there is a net loss. It is also possible to have negative cash flows from operating activities when a company reports positive net income. An important section of the statement of cash flows is the significant non-cash transactions. These are changes in the long-term assets, liabilities, and owner's equity accounts that did not involve cash. Some common non-cash transactions that a company should report include those that are shown in this slide. These are reported below cash at the end of the year in the statement of cash flows. Also, there are a few changes in the stockholders' equity section of the balance sheet that are not included at all in the statement. These include stock dividends, stock splits, and restrictions on retained earnings. Companies generally report these items elsewhere in the statement of stockholders' equity or in the notes pertaining to the capital accounts. In this objective, we will explain the use of a worksheet in preparing a statement of cash flows. When there are numerous adjustments and other complicating factors, companies will often use a worksheet to complete the statement of cash flows. The worksheet is just a tool to help in the preparation. It begins by listing the beginning and ending balances for all of the balance sheet accounts on each side of the worksheet. Then in the middle are two columns for the adjustments needed to reconcile the balances. These adjustments then correspond to an entry in the bottom half of the worksheet for the statement of cash flows. For example, the change in the cash account at the top will be the opposite entry for the increase or decrease in cash at the bottom of the statement of cash flows. The worksheet is easiest to understand when you actually complete one yourself, so there is a homework assignment using a worksheet, and you can watch the demonstration video of the problem where I complete the worksheet to understand the process. This slide shows the quiz hints for Chapter 23. Be sure to complete the homework first before attempting the quiz, as it will be helpful to you. Also, the second quiz will take you much more time than the first part, which is rather short. So be mindful of the time you spend on the first part so that you have adequate time to complete the second part. There is only one calculation on the exam for Chapter 23, and that concerns the calculation of depreciation expense when there has been a sale of equipment. This is the end of the presentation for Chapter 23, Statement of Cash Flows.